Welcome to the Corporate Venturing Insider Series, where I interview top practitioners in the CVC world and learn with you the best practices and golden nuggets that they have accumulated over their career. In this episode, we will be learning from James Mawson, founder and CEO of the GCV Institute. James, could you take a few minutes to share your story and how you got to where you are today?
Sure. Thank you, Nicola. It's a great pleasure and honor to be here today. Thanks for being able to host this amazing work that you guys have been doing around the world. I certainly remember when you were starting out as a firm, and the idea of taking globally venture capital at an early stage to different parts of the world was still pretty exotic and pretty rare. And the success that you've made of it is really exemplary for a lot of startups out there. So thank you for all the work you've done to make the world a better place. And obviously, Nicola, thank you for TDK for being such a supporter of the corporate venturing community. So I set up Global Corporate Venturing as the first publication in 2010. I was the private equity and venture capital editor at Dow Jones on the international side. So they run a number of trade papers, Wall Street Journal, Dow Jones Newswires, and various other bits and pieces. Before that, I've been an international editor at the Financial Times Business. And before that, I'd worked as a freelancer for The Economist and various other national newspapers and trade papers and in whole different areas. I'd also been a sort of foreign correspondent a bit, covering the European Union accession countries back in 2003. So anyway, my background from leaving university back in 1997 was more from the media side. On the journalism side, I did a War Studies and History degree at King's in London, which was great, actually. I've got to say I was a terrible student, but I enjoyed the course and enjoyed the people I met. And then I ended up in journalism. And by moving into the private equity and venture capital field through the global financial crisis, it was really the epicenter in many ways of the business stories of the day, which was the leveraged buyout bubble, particularly how debt had been growing, which was used in sort of mortgages. But private equity were picking up those same trends of CDOs or collateralized debt obligations, using leverage or borrow, improve their overall financial returns. We only write about independent VCs that raise money from institutional investors, the pension funds, life assurers, asset managers, and then try and invest in companies for the financial returns, give the money back to the LPs, take a stake as the money gets transacted through, everyone's happy. And so I think that was the sort of starting point. I was like, who does it was the first question, and what do they do? So I handed in my notice from Dow Jones at the beginning of 2010, had to work through my 3 months notice. And then in May 2010 started GCV. And the first publication came out in June, a couple of weeks later, and we had the website and the magazine up and running. And I think that idea of sort of corporate venturing, that idea of looking at things strategically and asking two pretty basic questions, who does it and what do they do, enabled us really to then track what fundamentally we hadn't seen otherwise, which was how many corporates back in 2000, 2011 were actually invested either directly in startups or indirectly as an LP and VC fund. There wasn't many, there was a few hundred. And then last year, 2020, there were more than 2,000 corporates. So we've seen near tenfold increase from the 200 plus that I actually started with in the Excel sheet back in early 2010. Everyone mentioned Intel, and then when you ask people, they would mention one or two others, and then you ask them and they would mention one or two others, and he looked at the data and he kept on going and built up that small list, and it's all done from an Excel. And then roll the clock forward over that past decade, we see nearly 5,000 corporates invest directly or indirectly. And here's some of the sort of GCV clients who attend our digital forum or our live events, or they subscribe to the publications, they join the Institute, the training academy, and otherwise they just help us really.
So my first question is really about, do you think that 10 years ago, the bad reputation that CVCs had, and this was not all CVCs, but as a group, was justified? And do you feel really the improvements that have been made justify these bad reputations to go away?
Yeah, good question. It broadly was justified. And the reason why a lot of VCs felt it was justified, it corporates weren't necessarily good partners in the syndicate or for entrepreneurs, is because they looked back, particularly at the dot-com bubble. So in 99, 2000, about 100 billion per year was invested. It's about 2.5 times that now, last year and the year before. So massive increase, even from the highest point, the highest bubble area in that area. The reason why so much money was invested in that 99, 2000 period, the dot-com first bubble, was because corporates came in, they came en masse, like Accenture would set up a $1 billion fund. They would do lots of deals at crazy valuations. Right at the end of the economic cycle, the markets turned, the NASDAQ fell, and all those corporates disappeared. They were doing it because they were in for financial reasons. They thought they could make some money, change their name, put a .com at the end. Analysts would love them. Their stock would increase. What was not to like? And the moment that changed, that financial reason went away, they all left. They left all their entrepreneurs in the lurch. They sold their stakes for cents on the dollars. It was just a crazy period of financial irresponsibility that didn't help the entrepreneurs and the VCs, which are in it for their career, 10, 20, 30 years, were like, we remember, we're not going to let you back in. Now, some corporates like Intel, Johnson and Johnson, Fidelity, others continue to invest through. They've got a longer track record. And over time, the better corporates who started to re-emerge back in did so more for strategic as well as financial reasons. And they learned from those corporates that went through the dot-com crisis and survived and thrived. And they said, maybe we should have set ourselves up more like that. But it takes time. It takes years for that reputation to change. So 2010, there weren't many corporates doing it. But the corporates that started in that 2009-10 period, think Google Ventures, think Tencent, think a whole host of others, they do deals at better valuations. They offer more support to their portfolio companies. An entrepreneur, she only wants 5 things. She wants capital, customers, product development, hiring, and an exit. Maybe now a bit more regulatory and geopolitical understanding as well. But broadly, those 5 things, if you can offer that, the entrepreneurs will love you. You're adding value to the business. And if you can hang around and reinvest to future rounds, the other VCs will like you. The corporates might buy other portfolio companies, not just from that one they've invested in, but other VC-backed ones.
Do you have some examples of these CVCs that have now 10 years track record, what they did really well, and why this reputation in the industry is improving is probably some of these early successes or good examples?
Yeah, funny enough, we actually have written a book on this exactly question, Nicola. It's called Corporate Venture and the Survival Guide. And when I say we've written the book, what it's actually done is by Heidi Mason and Liz Arrington, who did all the hard work. It's their thought leadership over 20 plus years. And they wrote it down and they say, how do corporates go through different parts of the longevity cycle? How do they get through those first 0 to 3 years? What happens at 4 to 6? How do they understand what the CEO or the C-suite might want? How do you get through executive change? How do you get through strategic change? How do you add value to portfolio companies at different stages of their life cycle? So that data I showed of the 4,000 plus that had done a deal, only 2,000 did a deal last year, which is great numbers, like I say. But the other 2,000 didn't. Why is that? And it's because it's really hard. It's really hard to not just find good venture investors. If it was easy, a lot more VCs would have a much higher IRR. But it's difficult. There's a lot of different questions that start to come out about year 3 than when at year 0.
So we're still young. So clearly, I want to know too, how do I get from the 0 to the 3+ years?
Yeah, it's a difficult question. I think just being aware of the types of questions or the types of issues is great, because then you can talk to your peer group at the other CVCs. You can send your team to the GCV Institute and Academy so you can improve the professional development. You can attend the conferences, read the publications, build your network, and then you can share war stories.
Can you tell me about how you feel about diversity progress in the last 10 years and how you see it going forward? And what would be your recommendations on how to do it better? Not just doing it, but better.
A great question. So if you take the overall venture industry, there's some great research out of Harvard, which says, look at all professions, legal, doctors, those types of people. Since 1970, they've broadly gone towards equality, towards gender equality, if we take that as one lens of diversity. Look at VCs, independent VCs, the venture industry, and it's stayed almost exactly level. It's up 1.8 percentage points, from 7% to about 8.8% of the overall industry are women. And that's within the industry. So why not that change? And then you look at what's called prevention. And it's one of the things we do. We track the number of women within the industry and how many of them are CVC heads and who are the rising stars and emerging leaders and what's the team look like. You know? And it's a lot better. It's really interesting that the majority of CVC unit heads who are on the power list, who are recommended or doing the deals by a peer group, are non-white male or non from that ethnicity of their parent company. You run a Japanese corporation CVC unit. Yep. Are you Japanese? Amazing investors like Anil and Andrew. Do they look like you? Do they have your same cultural background and professional background?
What do you think inclusion could do so much better now? How can we make it much better?
VC and venture was a local industry. The old rule of thumb was anyone outside of 20 miles of where you lived, you broadly wouldn't look at them all. But what we found, particularly in the past 20 years, but more specifically in the past couple of years, is that the information asymmetry between a VC and the entrepreneur has closed. Entrepreneurs can network as easily with other companies that the VC is backed and do due diligence on that VC. It's easier to get a track record. It's also easier to find other opportunities for what deal terms mean, but also other types of investors.
What would be your advice to people who are just starting? They are making their first minority equity investment.
You're spot on. So, you know, of those 2,000 plus corporates that did a deal last year, about 700 or more were doing their first deal. Record highs, each quarter by quarter, Q1, Q2, Q3, Q4, records each quarter compared to prior. Because people were using COVID to try and lean in to innovation. They realized that the parent company needed to do it, usually because they were affected. They had to start to do stuff differently. You know, so they had to start engaging. And a lot of corporates were doing more. You know, they had the cash coming in and they had to step in. They said, now's our time to find those entrepreneurs that we really wanted to work with. The first bit of advice is, well done. You've taken that leap of faith. You're doing stuff at a time that's slightly counterintuitive to venture history. And you started doing deals at a better time in the economic cycle. And if you do cheaper deals in less obvious areas, it gives you a better margin for error. You might be hideously wrong. You might choose to invest in X country or X sector, and actually the country tanks, the sector tanks, the entrepreneurs are going to struggle with those headwinds against them. You know, but taking that first step is important. Being thoughtful about the timing, being thoughtful about where you go. If you go into a super hot area here, it's going to be difficult for you to find good entrepreneurs. It's going to be difficult for you to find good co-investors. You're going to be learning and paying high multiples on stuff that you don't necessarily know what the hell you're doing. So the advice I would take is listen to Nicola. When Nicola goes, we had really good support from our CEO and we chose areas which wasn't obvious for our people to invest in, like advanced materials, which were challenging. Shock horror, 3 years later, those areas are actually a bit more interested and you've been able to get some great returns. That provides validation back to the parent company that you know what you're doing. And then it gives you more leeway to then carry on and do more deals. So the number one advice beyond start at the right time is think about what you're doing. If it seems hot, stuff written about in the Wall Street Journal and the FT, you're really going to struggle. If you're investing in not yet digitalized area here, or you've got a unique angle and it's widget there, whatever it might be, you've got a better chance. If you're doing it super competitive as a newbie, you're basically dumb money waiting to be fleeced.
I agree. With all of that said, what is for you the very best reason? There are many reasons, but what is the very best reasons for corporate to start a corporate VC? And this is your opinion. I'm not looking at statistics, just your personal opinion.
So it's a service profession. It's tough. It's hard to service your parent company and the entrepreneurs. It's hard to go out networking. It's a lonely job, long hours. Pay might be pretty reasonable compared to most industries. But that's not a great compensation if you're on the road, you've got family and you're going to different countries and you're getting terrible emails. Do it because you want to and you're prepared to put the hours in over a long period of time, usually without a lot of support and a lot of success. I think going in eyes open is the useful bit.
I think it's very useful because I think many people think it looks easy. You just invest in startups and then you get the reward. It's very hard to do very well. So I think that's really nice. What should CVCs not continue doing?
There's a whole load of things. The thing I would hate to see, you referenced it before, it's quite a collegial industry. People are prepared to share their war stories. The thing I was quite worried about a couple of years ago when it got quite expensive and rich, it started attracting people who basically thought they could get rich. And I think you're well paid and you've got the potential to get even better rewarded. But that real sort of mercenary, pecuniary attitude of I'm doing this because I want to be like XVC and be extremely wealthy if it goes well by taking 20% of the carried interest plus 2.5% of the assets under management. If you want to do that, try and become an independent VC. If you want to try and do it, it's hard to do as a corporate. And the concern I had, and still have at times, is the people sometimes coming into the industry are doing it for mercenary reasons. It's like being an investment banker 20 years ago or private equity executive 15 years ago. There's some really unpleasant, unethical people out there. And on the whole, CVCs are nice people. They're doing it because they think they could do it well. And they understand that while it's a perfectly lucrative career, there's a lot to be gained from helping entrepreneurs and helping the parent companies. To your earlier point, Nicola, it's not just about the entrepreneurs doing well. You've got to make sure the corporate does. Having a great idea as an entrepreneur and taking 20 years for your battery to be improved is good, but wouldn't it be so much better if it could scale up and you could get that electric vehicle battery to all the cars? So I think that opportunity to move faster and more rapidly to make the world a better place is fundamental, and it takes a partnership. Take COVID, a vaccine coming out of Germany, CureVac. It's funded by one of the founders of SAP. Nice guy, rich, invested in it, wanted it to do well, got it to a great position. They've just done a partnership with Bayer, very big pharma company, to scale it out. What's going to make the difference to the company? Stock rose 2%. Does the world get better if there is more vaccines for this wretched COVID thing? Yes. You need a partnership. It's not just individual. My concern would be is people coming in thinking it's a get rich quick scheme. If you want to do that, set up a Ponzi scheme, set up a hedge fund, because there's a really easy way to do a hedge fund and make money, and it's flipping a coin. It might work, it might not work. And it's all about just timing some of the insurance risk. So if you want to do that and you want to flip a coin, go into Bitcoin, go into hedge funds. There's loads of stuff within financial services, let alone some of the sort of corruption and other things that you can do. Just don't become a CVC because we don't want you.
The mercenary aspect, I think, is very important to understand. And actually, I'm going to share a golden nugget from Paul Holland.
Yeah.
He told us, don't call this startup that comes to you deals, which is very transactional. Call them projects. This is this entrepreneur's life mission. And therefore, in TDK Ventures, we never call them deals, we call them projects. It's a vocabulary, but it's also a way of thinking about the project. And I think it creates more respect, more appreciation, and the right mindset to it. Don't call these deals. They are projects. They are entrepreneurs behind who really want to have an impact in the society. And I think that when I see other VCs or CVCs that call them deals, it's funny because I start to have this little light coming in.
Yeah, it's a great phrase. I love that golden nugget. I might use it myself, actually. But yeah, I think it's spot on. Words have a power. Your intentionality, your affirmations that you put out there, what you want to sort of achieve. And it's the same otherwise. If you call it a deal and it's a transaction to you, it's so spot on.
So we're getting to the top of the hour, but I want to end with something inspiring. What do you think we can look forward to in 2021? And what can the CVC ecosystem really think about to make the world a better place?
Ooh. I think if you take a dollar bill, it says, "In God we trust." If you think about it and you say, "In innovation we trust," because you look at where we are now compared to 100 years ago. 100 years ago, we just finished the Spanish flu, just come after the First World War. That was not fun. 100 years before that, we just finished the Napoleonic War. That was not fun either. 100 years before that, pre-industrialization, there was some great stuff happening in Renaissance Italy in that sort of time period. But on the whole, the average person was not very happy, didn't live very long, and did not have a lot of benefits. Why are we where we are now, talking over the internet, thousands of miles from each other? It's because of people working together, believing in innovation, believing in a better future. It's not rocket science. Live for yourself, live alone, live for others, live again. And I think it's just being able to have faith that we can do this. We can make the world a better place. Can't do it by ourselves. We could do it together.
I love it. And maybe I'm going to add one more question, which is in that direction, which is many corporates start to take ESGs and sustainable development goals much more seriously. How do you see that helping making better investments?
It's a no-brainer, to be honest. So we did some work with the United Nations a couple of years ago, thanks to Charmian Love and Amanda Feldman. And what it did was it looked at the CVC portfolio companies, so 25,000 or so that we tracked, and then overlaid the SDG lens on them, the impact lens. And it's remarkable how many of the corporate-backed deals are SDG or impact orientated. They're not called that, but they are. And that's because it's not rocket science to say, if this is going to be targeting an underserved market, think illiteracy or poverty reduction, or it's dealing with climate change, like electric cars, you're more likely to be dealing with an issue that's hard, big market, and that people will want.
It's exactly what Gen from Sony Innovations Fund said to one of our earlier interviews. Startups want to make a better world. So most of them will fit a good purpose.
There's a lot of good out there, but a lot more corporates, if they looked at their portfolio, would realize they were ESG or impact orientated. They just hadn't necessarily termed it that way. So I think it creates a lot of potential. Future way.
Very nice. Jim, I want to thank you for this 1 hour with you. You gave a perspective that's you only can give. So I really appreciate it. Thank you very much for your time.
Well, it'd be my honor to hear the questions. I always find you learn more about the questions asked than the answered, and it's definitely true in this case.